Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Nebius Group NV.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's unpack this one. This company has just been on an absolutely incredible run in 2025.
It's really dominated the conversation in AI infrastructure, hasn't it? The numbers are almost hard to believe.
They really are. We're talking about a stock that is up over 200% year to date.
And that's not even the most startling figure. If you look at just the last 6 months, it's a 518% return.
That's just a structural shift being priced in real time. That's not normal growth.
It isn't. But, with that kind of extreme performance, you always get extreme volatility.
Right. It's never a straight line up.
Exactly. The stock is currently trading just under $100. But that's after a pretty sharp 30% pullback from the highs back in October.
And that pullback is a really crucial part of the story, I think. It tells you this is a classic high beta growth name.
Every piece of news, good or bad, is just amplified.
Totally. And it seems like the market is rewarding capacity, but it's also severely punishing any hint of dilution or delay.
Well, to justify that kind of movement, the fundamentals have to be, just beyond exceptional.
Yeah, so let's look at those. Q3 2025, what did we see?
They reported revenue of $146 million.
Which, on the surface, sounds almost modest for a company with this kind of hype.
It does, but context is everything here. That number represents a 355% increase year over year.
Okay, there it is. And I'm guessing the quality of that revenue is what's really driving the excitement.
You've got it. If you drill down into that number, the growth is almost entirely from their core AI infrastructure business.
Not from, legacy cloud services or anything.
No. That segment alone shot up 400%. It's now nearly 90% of their total revenue.
So they've successfully pivoted. They're not a general cloud player anymore. They are a focused, critical supplier for AI.
A pure play. They're providing the specialized hardware that these large language models need to even exist.
Which brings us to their future scale. This is the part that I find, frankly, a little unbelievable. They exited Q3 with an ARR of, $551 million?
Correct. Annualized run rate, $551 million. That's the baseline.
And the goal?
Management's goal is to hit between $7 and $9 billion in ARR by the end of 2026.
Okay, wait, let's pause right there. From $500 million to potentially $9 billion in ARR in about 5 quarters.
I know.
How is that even possible? I mean, that sounds less like a projection and more like a wish.
It's a huge challenge, and you're right to be skeptical, but the key to understanding it is their competitive moat. They aren't chasing customers.
The revenue is already locked in.
The revenue is locked in. They are executing on pre-signed, multi-billion-dollar contracts.
Okay, so this is where the big hyperscalers come in.
This is it. Look at the Microsoft agreement. It's valued up to $19.4 billion through 2031.
$19 billion.
And then separately, a $3 billion 5-year deal with Meta's AI division.
That kind of revenue visibility just fundamentally changes the story, doesn't it? It justifies the massive spending we're about to talk about.
It does. It basically gives them a guaranteed utilization rate for the data centers they're building. They've repeatedly said their capacity is, quote, sold out.
So demand is not the problem.
Demand is not the problem. The only thing limiting them from hitting that $9 billion target is the physical speed at which they can bring GPUs and power online.
It's a supply-constrained world, and they've already secured the demand. It's a logistics race now.
And that race is specifically about securing scarce resources. The most advanced chips, like NVIDIA's H100s, and just as important, the power grid connections.
Which creates a huge barrier to entry for any competitor. You can't just show up with a business plan. You need billions, and you need NVIDIA on speed dial.
Right. And that scarcity makes their tech stack even more valuable. This is where they create the lock-in.
You're talking about their proprietary software, things like the Aether 3.0 cloud and the token factory.
Yes, exactly. The Nebius token factory sounds like marketing, but it's a huge edge.
Explain that for us. What does it actually do?
In simple terms, it optimizes AI inference at a massive scale. Inference is the day-to-day use of the AI model.
So not the training, but the actual running of queries.
Correct. Their tools make that process cheaper and faster than running on commodity hardware. So if Meta is building models on their platform, they're using proprietary workflows.
I see. So the switching cost, which is estimated at over $2 million, it's not just about moving data.
No, it's about rebuilding your entire specialized workflow from scratch somewhere else. It's incredibly sticky.
They're making themselves indispensable, an operational partner, not just a hardware vendor.
Precisely. And that gives investors confidence in the longevity of those huge contracts.
Okay, so that's the bull case. It's aggressive, but it's grounded in these massive deals. Now we have to pivot to the risks and the cost of all this ambition.
The CapEx. It's the elephant in the room.
It really is. They increased their 2025 CapEx guidance from $2 billion.
Up to $5 billion. A massive leap.
And that money is being spent right now to deliver on that 2026 revenue.
And that spending is exactly why their net loss widened in Q3 by 26% to about $120 million.
Which, for a lot of investors, that's a red flag. Widening losses while the stock is soaring, it feels counterintuitive.
It's the classic growth versus margin debate. But if you look closer, the unit economics are actually very strong.
What do you mean by that?
The adjusted EBITDA margin for the core infrastructure business hit almost 19% in Q3. That shows you the business is highly profitable when it's operating at scale.
So the current net loss is all about the front-loaded investment. It's the construction costs today for revenue tomorrow. It's not operational inefficiency.
Correct. And management knows they need to prove this. They have an explicit goal to turn group-level adjusted EBITDA slightly positive by the end of this year, 2025.
That would be a huge inflection point for them.
It would be critical. It proves the model works.
Okay, but how are they funding that $5 billion CapEx? Because this is what triggered that recent volatility.
They're using a tool called an at-the-market or ATM equity program. It lets them sell up to 25 million shares over time.
And that's what spooked everyone, the D word. Dilution.
Yep. Investors hate the idea that future earnings will be spread across more shares. Even though they also raised money with low-coupon convertible notes, the ATM plan is what drove the sell-off.
So how should we think about that? It feels like necessary dilution to fund necessary growth.
You have to frame the $5 billion in spending as a time-sensitive land grab. The capital is to secure two things you can't just get later: power and GPUs.
They're aiming for, what, almost a gigawatt of power capacity by 2026?
Up to a gigawatt. That's the equivalent of a small city.
Wow.
And securing that in places like New Jersey or the UK is incredibly expensive and complex.
Yeah.
But it's the prerequisite for meeting the Microsoft and Meta demand. If they wait, they lose.
So the financing risk is a trade-off for ensuring the multi-billion-dollar revenue targets actually materialize.
That's the bet.
Okay, let's talk about the market itself. After that 30% pullback, what's the technical picture look like? Is this a healthy reset?
Most analysts seem to view it as a healthy consolidation. The fundamentals, the contracts and the demand haven't changed. What's more interesting is who is buying on these dips.
Right. Tell us about that.
We're seeing significant institutional accumulation. Hedge funds, major institutions, they now own about 22% of the float.
The so-called smart money.
Exactly. They're using the volatility and the fear around dilution as an opportunity to build their positions for the long term.
So while retail might be selling on dilution fears, institutions are underwriting the spend needed to hit the 2026 goals.
That seems to be the case.
But even they have to be looking at the two biggest risks here. Number one has to be customer concentration.
Absolutely. The reliance on Microsoft and Meta is a double-edged sword. The deals are massive, but if either of them suddenly shifts strategy or hits a delay,
Nebius's revenue visibility takes a massive hit.
a huge hit. And the second risk is just pure execution.
Right? Spending the $5 billion is one thing, actually building these complex data centers across multiple countries on a tight deadline.
It's an immense logistical challenge. Any delay in permits, power, or, most critically, the NVIDIA chip deliveries could jeopardize those big revenue numbers for late 2026.
But with big risk comes potential upside. What's the speculative chatter around this name?
There's quite a bit. First, there are persistent rumors of a private equity buyout. Names like KKR and CVC have been mentioned.
Which would provide an immediate premium to shareholders.
A huge one. Second, the market is watching for new partnerships. Imagine if they signed a Google or an Amazon as a third anchor tenant.
That would immediately solve the customer concentration risk we just talked about.
Instantly.
Yeah.
And finally, the technological trump card.
The rumored MB1 chip?
Yes. The possibility that they're developing their own proprietary AI chip. If they can pull that off, they move from being reliant on NVIDIA to a truly vertically integrated AI platform
Which would boost margins and switching costs through the roof.
overnight.
Okay, so let's bring this all back to the near term. For you, the listener, what are the key catalysts to watch over the next 3 months?
The single most important event is the Q4 2025 earnings release. We expect it in late February 2026.
And that's when we get the first detailed guidance for 2026.
Yes, investors will be demanding confirmation that the $7 to $9 billion ARR target is on track.
And that guidance needs to be tied to physical assets coming online.
Absolutely. We need to see tangible proof that capacity is being delivered in the first half of the year, especially for that massive Microsoft contract. Any sign that revenue could be pulled forward from the second half of 2026 would be a huge vote of confidence.
So the next few months are all about execution, pivoting from promises on paper to tangible operating data centers.
That's it. It's about showing that the $5 billion in CapEx is translating directly into contracted high-margin revenue, and critically, that they're making progress toward that group-level EBITDA positivity.
So the bottom line seems to be that Nebius is a high-conviction bet on the structural demand for AI compute.
It is, and it's backed by contracts with the biggest names in tech. But it forces the investor to make a trade-off.
You have to underwrite the high spending, the dilution, and the execution risk.
In exchange for what could be a massive multi-year revenue ramp, it's a classic hyper-growth story. The question for you is whether that potential reward justifies taking on that level of near-term risk.
That certainly gives us a lot to think about as Nebius charges toward 2026. Remember to hit that subscribe button to catch our next analysis.